V Srinivasan, ED Corporate Banking at Axis Bank as well, joins in on the show. Mr. Srinivasan, hi, morning. The recent WPI inflation number at 7% seems quite surprising. Some believe it also may force the RBI to hike repo rates further. What's your sense regarding this?
I think the WPI number of 7% was broadly in line with expectations. And if you look at what the RBI governor said a couple of days back, clearly it indicates that he wants some of the effects of food inflation to wear out and clearly then take a call. So he's indicated that he's going to be a little more patient, and from that one should sort of take a cue that rates are broadly going to be stable, and just because of WPI inflation at 7% would not automatically indicate that a repo rate hike is on the cards in the next policy. I would still think it's wait and watch, and the odds are that rates are going to be unchanged in the next policy.
So on the flip side, growth numbers have not been too great. Are you expecting any significant pickup in the growth numbers soon?
Growth is going to stay muted. I think the second half can be a bit better than the first half, but growth is likely to stay muted. If you look at the full year as far as FY14 is concerned, growth is possibly going to be a shy short of 5%. So the growth inflation dynamics clearly is a challenge, where growth is to some extent struggling, whereas inflation continues to be fairly stubbornly high. That's the situation we have to grapple with, and what I think will happen is steady range-bound rates unlikely to come down, but unlikely to go up sharply either.
So what's your outlook on bond yields against the backdrop of these facts? Also, the RBI has announced an OMO of 8,000 crore rupees for today. What levels do you see the bond yields settling at in the near term?
I think levels about 9% seem attractive from a medium-term perspective. You could see some spikes, but broadly I think levels of 9% or higher from a medium-term perspective are levels to sort of buy and hold. And I think it will be quite attractive in, say, the next financial year.
Do you feel asset quality concerns will come off for the banking sector in the second half of this fiscal, and which sectors, to your mind, continue to remain really points of stress?
I think it's reflective of the current environment. As I said, growth is muted, and asset quality, which we are witnessing, is in line with what we're seeing in terms of the overall environment. It is still too early to say that things have bottomed out and things are going to look a lot better going forward. I think we need to wait and watch for the next couple of quarters before we take a more clear call as far as that is concerned. I think as of now, we continue to remain cautious. We continue to sort of expect restructurings and non-performing assets at a run rate which is broadly in line with what we've seen in the first half. The second half, as far as this is concerned, is unlikely to be very different from the first half.
So are you seeing any signs of corporate credit demand picking up anytime soon? Which sectors do you think would drive the demand for your bank?
I think still early days. We're not seeing any big projects being announced or come to banks for financing. As of now, it is primarily working capital as well as refinancing, which has been bulk of the corporate demand. And even otherwise, corporate demand continues to be fairly lukewarm. So we got to wait and see for the next couple of quarters, as I said again, to see if any of the green shoots, as we sort of seem to be sort of feeling, actually translates into capex cycle revival.
Finally, are you looking at any overseas fundraising? Do you feel there is need for a concessionary swap window on FCNR deposits to be extended?
Clearly, every bank will do whatever it can to try and get FCNR money in, because the rupee landed cost of funds is clearly attractive compared to other sources domestically. So that's what we've seen reflected in the numbers of more than $17 billion coming in through the FCNR route. It's likely that we will be upwards of 20 billion by November 30th, which is when the swap window closes. In my view, it's unlikely they'll extend the swap window beyond November 30th. I think if you look at the overall current account deficit as far as this year is concerned, and the FCNR deposit which has come through, I think broadly the financing of the current account deficit is comfortable with the current numbers, and it's, in my view, it's unlikely that it'll extend the date beyond November 30th.
Okay, we'll leave it at that. Good speaking with you as always.